Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multi-family investor, really any kind of real estate investor, you're in the right spot. Every week on the Gray Report, we are breaking down the latest research reports, articles, new data, original opinions from the Gray Capital team, all right here, covering the multifamily industry, real estate, and the economy. Some really interesting topics today. We're looking at rent growth, how it compares to wage growth. Are wages keeping up? The conclusions are a little bit surprising, to be honest. Household formation, are people moving in together, moving out, signing new leases? We're going to find out. We're going to be talking about inflation, and then we're also going to be talking about home builder sentiment. Are the builders wanting to build more or not? I think you may have an idea, and if any of these topics you're not sure what that means, well, you're in the right place. We're going to be breaking it all down. Matt Bosnagel, Director of Communications and Marketing from Gray Capital, is here to help us through. All right, let's get into it. All right, everyone, welcome back to the Gray Report. I hope you're having an excellent day. You're having a good week. Matt Bosnagel is back on the report with us once again, as he is every week. Matt, we got a slew of some really interesting reports on the multifamily industry, kind of real estate this week.
Yeah, things are starting to really churn. I think last week was a little bit of a little bit of a reminder of inflation and this like super hot economy, even though people didn't really need a reminder. This week is just it's more the same, but there's this anxious anxiety and a feeling that the Fed's going to come back next week.
Yeah, I think that it feels like we're at an inflection point, but like we're not all the way there, but like we're in the zone of where if things are going to start to move, they should, and if not, that is significant in itself. And what we mean is, rates have already moved considerably, and how is that going to start affecting the pricing in these incredibly low cap rates in the commercial real estate and multifamily market? But is it the economy as a whole? Because there's a seasonality element too that we've discussed in the past, and not just real estate, but things typically kind of slow down post-July a little bit. And if we don't see that slowdown, it means there's just incredible, more and more growth. That signs that inflation is going to be kind of sticking around at higher levels for longer. And again, there's good sides to that, good rent growth, good revenues up. But on the downside, the Federal Reserve is going to have all the ammunition to really raise rates. And there's some people, myself included, thinks, hey, we got to move the Fed funds rate up even faster because the Fed is just so far behind. Let's just get this thing moving.
It's interesting. Some of the reports here kind of mention inflation and how inflation is this. It's general inflation. It's all the prices rising. But in terms of inflated prices, we've been seeing that. Builders have been seeing that for the past 2 years. And if you add that and inflation on top of it, it just seems like there's things are going to get difficult for builders, especially given that people are demanding houses a little bit less because of the mortgage, because of rising interest rates. I think that demand is still pretty strong though, and demand could be, demand for houses and everything. They just ate up that 75 basis point increase. Everyone kept hiring. Inflation kept going.
It certainly has an effect the job market. That's for sure.
Yeah.
And I mean, it has affected without a doubt the single family home market because those buyers, it's just become unaffordable. They can't choose to pay more than they qualify unless they've got a co-signer or someone, and they just can't justify that payment. And that's really driving more people into the rental market or keeping them into the rental market. We probably are going to see hundreds of thousands of individuals that would have bought a home over the next year or 2 years. They're going to be choosing to rent. That should buoy occupancies. But just to transition to this first piece from RealPage, the question is, demand may be at a certain level, occupancy may be at a certain level, which typically means rents rise. But what someone earns, their income, they can't rent more than what they can afford.
That's a fundamental driver, I think, for sure.
It's a limiter. If someone's only making X, you can't charge significantly more of where their rent is making up more than 30% of their income. And I think that's been the concerning factor for a lot of people for years, pre-pandemic. What we've seen is not necessarily that wages push rents, but the inverse of rents pushing wages. And I think circling back to inflation, this is the longer tail effects that I don't think were really baked into the Federal Reserve or other economists' thinking, in the sense that they thought we'll just get through the supply chain issue and all will be fine. We'll go back to kind of a normal range. But you have all of these other kind of secondary and tertiary effects, like rents rising, other prices rising, which then are going to cause wages to rise more. And then it gets this spiral that we've talked about in feedback loop that's going to probably keep things moving for at least the foreseeable future.
Yeah, that is interesting. And just for a second, I am kind of particularly interested in how you are and how Gray Capital is kind of navigating the inflation environment in terms of like your ongoing projects and the decisions that you have to make, maybe not necessarily as in terms of like acquisition, but in terms of like, okay, you got the properties. How are you, getting the best bang for your buck, and how are you factoring that into your long-term strategy?
Well, I mean, maybe just talking about some of the challenges, first. And to be honest, once we've closed on a deal, interest rates don't matter as much. They certainly matter, from a valuation perspective.
I'm sorry, I was talking about inflation. I was thinking about the cost of all the labor and the materials.
That's the biggest. I wouldn't even say the wages or payroll. I mean, wages and payroll certainly have gone up. Utility prices have gone up. Material prices have gone up. It's the availability of the right staff and the right people is really the challenge. I mean, you could, with rents increasing and revenues being up and occupancy very high, it's worth paying up, I believe, to get the right people, in the right positions. But the challenge is finding the right staff, the right team to actually hire and to be fully staffed. I mean, that's a big challenge that we're seeing at a couple properties, is just getting fully staffed with the right individuals. Maintenance staff, maintenance supervisors, maintenance techs it's been a challenge to have those positions fully staffed prior to the pandemic. It has for the last 5 or 6 years, because there's so much competition for those roles. There are other jobs that you require a similar skill set that even sometimes a simpler skill set that maybe paying more right now. An example would be, an HVAC company. I can be a maintenance tech or a maintenance supervisor. Maybe I'm already HVAC certified. I probably can make more working for an HVAC company than as a maintenance supervisor at apartment community. And instead of working on, having to be a jack of all trades and, replacing siding one day and carpet another day and, railings the other, and then working on HVACs, you work for the HVAC company. That's just, you fix air conditioners. That's all you do. Then with, all the infrastructure spending, we have a lot of competition just for, physical, daily work, and someone can typically get paid more. I mean, like the state of Indiana right now is paying very competitive wages, getting people to, fix the roads and bridges and all of that. So it's
interesting.
That's incredibly difficult. The material side, things are definitely more expensive. I would say that the rent increases, are kind of outpacing that concern of, the ROI on renovations. Again, it's the timing on some things. It's not as challenging as it was, but it's still not easy. It's more of the kind of the scheduling and getting the right vendors to be able to get the work done and getting on the schedule. Fortunately, we've got in-house construction and team that's dedicated to that, and they're on top of it. But it's still a big challenge right now. But but we've made 2 acquisitions in the last couple months. We're fortunately able to navigate the whole interest rates rising environment successful,y although it was a challenge. But now we're just on to executing the business plan and getting it done.
Great.
Yeah.
Well, that's good. That's interesting. I wasn't thinking about the availability of labor as this chief, puzzle piece. It's kind of hard to find.
It's incredibly difficult. Wow. Again, it has been, but it's only gotten worse.
And you can't just tweak. You can't just raise the wages a little bit and expect people to come flooding in.
I mean, you can a little bit, but no, it's just hard to find people and to find the right people. And then there's a lot of turnover in those positions also, which is challenging. It can be expensive. But let's get back to what we were talking about on rent growth, income growth. RealPage had a really interesting report. I think it's a pretty unique one in a sense of the size of the report. So the headline is Market Rate Apartment Renters Spending 23% of Income Towards Rent. Now, if you're not familiar with kind of the average ratios and percentages, it's actually a relatively modest or relatively low percentage of one's income. Kind of the typical ceiling of what one should pay of rent out of their income, and it's typically the level you can qualify is 30%. So, it's basically a little over the 2/3 of the way at max capacity.
Yep.
And prior to the pandemic, there were a lot of markets that were even over 30%. And so in terms of affordability, we're not so unaffordable of where we're outside of kind of normal parameters. But I think that there's a lot of studies that have looked at this in the past, but this study in particular seems to be a little bit more larger, and they're also looking at, instead of just rent growth in a vacuum of one set of cohorts, and then we're going to look at wage growth of like another set of cohorts of like national rent growth and like national wage growth. I believe this study, and Matt, correct me if I'm wrong, I think it was a study of over 7 million leases and renters, but they're comparing the wages of the wages and the rent of the same cohort.
Yeah.
So we're not looking at two separate groups.
Yeah, I think that they captured that, and they have a whole section at the end of their methodology, which I always appreciate. I think that this is a good. The opener itself of this article is particularly interesting, and it name checks the eviction tsunami, and it says.
Oh, did that ever happen?
Well, that's what
I forgot about the eviction tsunami. Oh my god!
Sometimes I think, like, is it coming?
We need to go back to those headlines.
I know. Well, and I think that they make a really good point. Is that rather than kind of distinct policy decision. RealPage argues that there's a more significant driver keeping rental distress and evictions low. The vast majorities of renters were able and willing to pay the rent. The tsunami hasn't come, didn't come, probably won't come, because renters keep paying rent. Renters are ticking up when it comes to the rent-income ratio. Now, near term, yes, rents have gone up compared to wages, but we're not teetering. Wages went up 15.6% in the past year, but rents for new leases went up by 21.9%. That seems like a tough figure to swallow, but 51% of renters were renewals, which didn't see as fast of a rent increase as new leases. Also, the actual rent-to-income ratio for market rate apartments only increased by about 2% in the past 3 years. So from 2019 was the low point, as you can see on this graph here, for rent to income ratios at 21.3. Now we're at 23.2. And this chart here, it even kind of exacerbates the shift here. We're really not that much different than we were in when it bottomed out at 2019, and it's been at this level, historically in 2011 when we're talking about rent to income ratios. So 23.2, is that what it is? Yeah, it's not. It is not. I'm sorry. It's not a once in a lifetime thing. It's common. It's happened in 2011, and I could see it increasing even more, even beyond then.
Yeah, well, I mean, even this graph that we're looking at, if you're listening to the podcast, it's from 2010 to 2022, and back in 2010 through 2014, median rent was much higher, respectively, than wage growth.
We're coming off a 8-year trend of declining rent to income ratios, and we are. Here, this is a good quote, actually, and it kind of provides a little bit of context and some information here. Median signed rents, actuals, not asking rents, were increasing slightly below income growth from 2016 to 2019. So rent to income ratios inched back as low as 21.3 in 2019. That's the low point. As housing demand and renter income soared, actual monthly rents jumped 11.5 in 2021 and 9.3 so far in 2022. And those increases reversed the patterns of descending rent to income ratios. The median rent to income ratio in 2022 to date measured 23.2, matching the level of 2011. So that's kind of in a nutshell what was leading up to this, and why I don't think it's safe to raise the alarm bell, to sound the alarm here when we're talking about middle of the road renters of market rate apartments. I'm not talking about affordable housing. We're in a pretty good spot right now, and there's room to grow. This is a good chart here, and it talks about the rent to income ratios when it comes to property class. And as kind of assumed, and this is something that we've seen, especially when it comes to rent growth of Class C properties being lower than A or B, despite the fact that vacancies were lower in Class C properties.
So it's interesting here. I mean, it makes sense. We've seen that lower rent growth in Class C because there's just not the room to go. I mean, they're considerably. Their rent to income ratio is closer to that 26 mark, whereas, I mean, the Class A, I mean, they're closer to 20. So they've got a lot more room to go. And that makes sense because, again, these people, Class A, those people might have been looking at buying a house. Mm-hmm. So they've got extra money. They've got extra income. Yeah. They're just renters by choice rather than by necessity.
Yeah, and we saw that squeeze, and we've talked about this before, how there seems to be this hard limit. And then that hard limit, and this is where I think that you were right when you said earlier how wages are more of a ceiling. Mm-hmm. And we're possibly bumping up against that ceiling a lot quicker for Class C properties for kind of the workforce housing and renters by necessity than we are for lifestyle renters or kind of middle market rate apartment renters.
What I think is going to be interesting to see, and this goes back to our discussion over maintenance supervisors, maintenance tech, and just in general kind of that more blue collar work, that workforce housing
mm-hmm.
community, is that where we're going to see a lot of wage growth in the near future. It hasn't really started to accelerate
mm-hmm.
yet. But if you think about it, there's just so much demand for those types of jobs, and there's only so many people doing them.
Mm-hmm.
You would think that those wages would start to come up, considerably at some point, but we're not seeing it. We're not seeing it just yet.
Yeah, it seems like it would take a little push in that group, and things could really start moving along. It's a really influential, I think, segment of the market.
Now, I do think how much I think is up for debate and when and all of that. But I think the Class A renters and Class B renters, I think at this point, there's some room to run on both of those.
Yeah, for segments. Sure. But even so, we talked about A, B, and C, and according to RealPage, even the most cost burdened is only at 26%, which is less than 30%, which is the commonly understood to be cost burdened. So if you are technically cost burdened, or what, this kind of government, and there's policies that define this at around 30 or maybe 33%. Now, this isn't a mic drop moment, and it's a little mean and simple to think that's the case here, but we're not cost burdened right now. We've got room to grow. Now, I do think that affordable housing is a little bit different. I am not denying that there are low-income renters that are extremely cost burdened, but I think that for market rate, for the kind of capitalist forces that are determining this, landlords aren't bumping it up past cost burden. They're not making these people cost burdened, and if anything, it is a case-by-case basis, and perhaps even a market-by-market basis.
I think so. I think some of the really high-flying markets, you're seeing more widespread, just blanket major increases, kind of regardless, because they know that there's the demand there, the renters out there, where others are being a little bit more moderate. Just another graph from this RealPage report. Market rate apartment renter demographics are not shifting as much, because I think that it would be a reasonable theory to make that the reason why the incomes are going up, especially in Class A, making them not nearly as rent burden, is that you've got home buyers that are, instead of buying, they're renting. But this graph is basically saying, if that would be the case, you would see the age of renters increasing.
It's increasing a little bit.
It's increasing. Well, it's increasing from 2020 and 2021, but it hasn't increased from. It's actually lower than it was in 2017.
Yeah, it's lower than it was in 2019.
So pre-pandemic, 2017, 2018, 2019, the age was all right around. I mean, it's basically unchanged. I mean, between 31 and 32 is the median age. But now the average number of lease signers. So this is looking at, are people moving in together? That also has not gone up, and we would look at more signers on a lease as people, roommates, and not, instead of renting 2 apartments, they rent 1. But that hasn't gone up. In fact, that has declined in 22 compared to 2021, and is essentially on par where it was in 2018.
Yeah.
So we're not getting as many people moving in with each other, signing a lease together yet. I don't know. Are we gonna have a report that
I think
counteracts that?
We should move to that next. Actually,
let's move it. Let's check another source on that.
All right.
But the median age essentially is unchanged. So what they're saying is the same cohorts are making more money than they were in the past, and allowing rents to still be somewhat affordable.
That's really interesting. Last year and a little bit earlier this year, I saw some oblique references to Gen Z, but no kind of hard numbers to back that up. But more and more, I've been thinking of Gen Z as this real power and a real, they're going to start moving into the rental market, and they're going to start taking a significant share of the renter population. As much as there is this story of millennial would-be home buyers, or even baby boomer would-be home buyers, kind of keeping the age of renters up, I think that the amount of Gen Zs that are coming in now could reduce the median age.
Yeah, no cap, Matt, on that.
That's a Gen Z.
Yeah, is a Gen Z parlance. I mean, it makes sense just because millennials are at the age where they like to buy a home, forming families, and all of that. Or Gen Z are at a college needing to rent. Now the difference is the millennial generation is larger than the Gen Z generation, and then how many millennials hold over. But I totally agree that target demo, I mean, is if it's not Gen Z tomorrow, it is over the next couple of years, without a doubt. And that's going to take really understanding of who that renter is, what they want, what their preferences are, but still catering towards. There's going to still be a large group of millennials and even Gen X's and baby boomers that are still going to be renting, and you can't ignore, because millennials are going to be maintained as the largest demographic group, and a lot of them are going to be renting. So you got to cater to both.
Yeah, I think that one of the big reasons why we're seeing this like surge of Gen Z, why it almost seems like it's coming all of a sudden, is because the pandemic has really messed with that gradual shift from millennials to Gen Z.
It absolutely has, and unfortunately, there's another tale of two cities, but there's going to be a cohort of millennials that miss the train on buying a house. Yeah. Where if you were able to get in, lock in a low interest rate pre-pandemic, during the pandemic, there's going to be those individuals that are going to see some significant wealth creation over time. And then there's another group that is going to be continuing to rent. Not that renting's a bad thing to do, but they're not always also investing on the side. Yeah. Whereas buying a house is like an automatic investment and kind of savings plan. In a way, not always the best investment you can make, but it's better to have some investment and some allocation besides your 401k or whatever than nothing.
Yeah, it's going to be really, really interesting, and I think that there are some lasting changes that are going to be made in the makeup of renters versus homeowners. And I just hope that, instead of it being due to difficulty, it's due to preference, because there are other ways to save your money and all that kind of stuff.
Yeah. Yeah. Well, I recommend reading this whole report. It's a lengthy report, but it's really good if you're curious about in asking questions or answering questions, maybe prospective investors that you're working with, of are rents rising too much? What are our incomes? This is some really good data instead of just speaking anecdotally of the rent seems too high and I don't think wages are keeping up, or wages are up, or rents are, whatever your thought process may be. To gain some data is really important. And so hop on over to grayreport.com, sign up for the newsletter to get this sent directly to your inbox. But also I recommend, if you were on LinkedIn, I really recommend following Jay Parsons from, he does a lot of these reports for Real Page. He does a lot of insightful posts. He gets quoted in the New York Times pretty frequently. So really good person to follow. Love to have him on the Gray Report to break some of these reports down. But yeah, I recommend checking it out. Sorry, Matt, not to
No,
I
was going to say, next time someone talks to you about, now they're really starting, rents are really starting to outpace wages. I read this article. Well, you can point them to the Real Page and say, not so fast.
Well, the point of the Gray Report, you can be like, you're obviously not a consumer of the Gray Report. You are missing out. You are behind the curve.
That's right.
It's true, man. I mean, I think you said it yourself. The smartest investors are the ones who are consuming the Grit Report.
That's true. I was
did
selling
I make that up for you?
No. I always say that. You're right.
All right, let's go on to Redfin. Rental market tracker. Asking rents rise 14% in June, the smallest increase since October.
Yeah. Another week, another multifamily rent report, except this one came out last week. That's fine. I'm including it because I've noticed a lot of general news sources, bigger publications, when they dip their toes into...
They go for Redfin.
They go for Redfin. I think it's more likely than not that they're going to cite
You think
reports.
that's just because it's like a brand name people are familiar with?
I think so, yeah.
Yeah.
I'm a little disappointed that Redfin no longer has a side-by-side comparison of rents and average monthly mortgages, but that's fine. I think.
Do you think there's a reason for that?
Yeah, it's there.
What are they? What business are they in?
They're in the business of reducing their staff, but I'm not going to.
Yeah.
So their report says that rents inched up in June for a 0.7 month-over-month increase. That, if extended to all 12 months of the year, would come to an 8.4% annual rent growth, which is well above historical averages. That's just annual. If I extended this monthly rent growth, the actual year-over-year rent growth was measured at 14% in June. And I can't get over the fact that they're saying it inched up. 14% is not inching up, is it?
Well, I think it inched up. This whole year has jumped up, but this month was, I guess, an inch.
Yeah, so
I guess
I'm just comparing it, and because we've read last week and week before from Yardi Matrix and Apartment List. Yardi Matrix measured a 13.4 year-over-year rent increase, called it rolling along. I like rolling a lot better than inching. Apartment List measured a 14.1% year-over-year increase and described rents as holding steady, which I still think is better than inching up. I think that the fact that they are within 1% of each other is notable. And that's kind of worth mentioning in and of itself. And I think that how they characterize it may have something to do a little bit with their audience. But again, it's definitely well within the same percentage points, and it's all quite elevated. So I'm pretty excited about that.
It's interesting. Cincinnati's has been on a tear recently. They're tracking 39% year-over-year rent growth in Cincinnati. I mean, we're used to seeing that in southeast markets like a Tampa or Austin, but the Midwest is showing up, man, in Cincinnati, Ohio. Great market, just a little bit to the southeast of us.
Yeah, I noticed that too. I pull out the little market report.
And that's, again, it's a reminder, and one of the reasons why we target the Midwest, beyond the fact that we just know those markets so well, is that there's the amount of dollars flowing into Cincinnati aren't the same amount as the ones flowing into like a Houston or an Atlanta or Tampa or Miami, but like the growth is almost as good. I mean, now is even better than some of those markets in a Midwestern market, but you're paying a higher cap rate, which means more cash flow. Yeah. You can argue that the higher growth markets can be, perceptually or perceived higher growth markets can get a lower cap rate, maybe more appreciation. We find that the total IRR, total return, is very similar between both markets, but you're getting much more cash flow in the Midwest, and so you're getting that money up front. And so if cash flow is important, it's whether the Midwest is a pretty unique region to invest in. I think the secret's a little bit out of the bag, but I'd say the difference is people maybe know about it, but they don't know how to execute. They don't know the markets, the submarkets,
that's true.
The networks, and how do you break into those markets?
And even just given like the impression of the Midwest compared to like a Phoenix or a Tampa, they're not necessarily sleepy, but they're not these hustling. But it seems a lot more risky. The towns and the markets themselves, have had these boom and bust cycles, and we can go back, and see in 2019 how things were doing, and it was a lot different for some of these markets. They can go up and down. Well, the stability of the Midwestern markets is almost mirrored by the stability of the cash flow of the assets within it. So it's a nice little parity.
Steady eddies. Yep. No, I think a lot of people, they think of the Midwest and they're like, what is actually going on there? Like, what do people do there? There's economic activity? People are moving there, and it's just like an unknown.
Whole lives there.
Yeah, people. You have internet there?
Yeah.
And so it's just they just don't know. It's just ignorance, and which is totally fine. Which that's where the opportunity is.
That's right.
Because it's like, well, no, I've read about Tampa and Phoenix, in Houston and Dallas. I haven't read about Cincinnati or Indianapolis. I haven't been paying attention. Well, there's a lot of markets. I mean, there's 50 states. There's a handful of good markets in each one of those states.
Yep. There's a handful. There's a great submarkets.
There's good submarkets and bad markets.
So it just pays to really pick a place that you know well, you're comfortable with, and then you can make those decisions.
Yeah, 100%. All right, so apartment list, Matt. More than 2 million households dissolved, then reappeared.
That's right.
During the pandemic.
So I was kind of hinting at this when we were talking about the Real Page article. I think it pairs well with it. This report on household formation covers the pandemic-related dip in household formations with some additional contextual information that really kind of pulled me in. Yes, you could read the headline and be off on your merry way, but the details on behind this sudden drop and equally sudden recovery might explain household formation trends more generally. You can see how the household composition in the last half century has shifted. There's a graph here that shows how nuclear families went from a large percentage, the largest share in 1970, and really started decreasing. Now it's the third largest, maybe it's 20%, with married couples at 22%, and the largest share now is single people, and it hasn't changed much since then, except for this little dip here. One of their main points was that this shift in household formation, at least at initial moments of the pandemic, was largely due to single-person households, which are, as I said, the largest cohort. Single-person households were in the negative from March till October. So it's that line graph above. So there's a line graph here that shows from 2018 to 2022, and you see a large dip right at right around
the pandemic. Yeah. I remember that. Yeah, household formation just dropped off.
Yeah. So who are these single-person households? And well, it's the young people, says Apartment List. Gen Z renters experienced the most dramatic swings, dropping more in mid-year 2020 and rapidly growing ever since at a rate that far outpaces other age groups. They dipped down lower and they recovered higher than other age groups. I have to give it to Apartment List here because it's rare to see such a simplified and easy to understand story that's backed up so nicely with data. Apartment List argues that these Gen Z renters went back home for a little while during the pandemic, and then after October of 2020, they started going back to renting their own apartments. It makes sense to me on the individual level. You can see the increase in nuclear family households right as single-person households were going down. And then once single-person households went up, nuclear family households decreased. They went back to living with their parents, then they went back to living on their own. And the same thing happens with, I'm living with a child. Those went up. And then living with... And then they went down after, when the single family went up.
And I think everyone watching and listening has a dozen anecdotes of where they're like, that makes sense. I mean,
exactly.
Like half of New York City went home, moved back in with their parents, and then 6 months later they're like, I'm going back to New York or moving to Miami. Or somewhere else.
Go to Tampa and Boise.
Exactly.
So this is interesting, and it does seem like people went back to live with their parents. Not necessarily were they becoming roommates, which I think is understandable in the pandemic sense.
Yeah.
In that, you'd rather hole up and be sick with your family than with someone that you may not know.
Yeah.
So
makes sense.
I thought that was very interesting. It does back up Real Page's point about the fact that we're not seeing a whole lot of roommates. I think if you scroll down even on this study, you'll see a chart that says where roommates are, and it's not pretty. It's in the negative really throughout. So we're really seeing a decrease in the amount of roommate households.
This will be an interesting stat to continue to track.
Yeah.
Over the coming months, for sure. Does how that roommate number increase? But this roommate number having declined, that pairs pretty well with the Real Page report.
Yeah. Oh yeah, for sure. And I think that Even anecdotally, and I guess anecdotes are truth now because we've got these evidence that may prove it. But anecdotally, I've heard of someone that they just couldn't work from home. During the pandemic, they were in the living room, someone else was in the living room. They're working there. They don't have to hole up in their bedroom all day. Yeah. So if they can live alone, they have a nice office, and that works a whole lot better than trying to argue with your roommate.
Something I find interesting, and I haven't gotten a good answer, is this aggregate change in renter-owner households since January 2020, and there's a drop off on renter households in the early on in 2020, but and then it kind of gained steam. Is this purple? That's where it's an increase of renter households map. So, but what's interesting is even with losing maybe 5.5 million renters like just over a couple months in 2020, occupancy rates went up.
Yeah, I think that it's because I think the pandemic related trends and the recovery from the pandemic drops are coincidental with these larger scale shifts, especially kind of when it comes to these Gen Z renters. They were coming of age almost exactly the point when the pandemic happened, and then they're all going to want to go and get jobs and move out on their own, and they're doing that, and so it's increasing, it's really accelerating pre-existing trends of recovery from the pandemic.
So it's the households. Renter households could be declining, but instead of having a bunch of 2-bedroom households, 2 people living together, it's more singles, and so you can have a total number of households, but there's more just single individuals, so it's increasing the occupancy. So I'm still trying to trying to square losing renters, and on that graph doesn't show a major increase in renter households, yet at the same time, physical occupancy is at an all-time high.
Yeah,
where are the where are the new people coming from? It's not showing up on that report.
Yeah, it could. I guess. The only thing is if that's measuring full population rather than the amount of households. But yeah, I'll have to look into that.
It'd be good something that we should figure out on for the next week's report.
Yeah, I'll follow up.
All right, Matt. Next on the report, we've got a report from the NAHB, the National Association of Home Builders. Builder confidence plunges as affordability woes mount. This isn't too surprising, I'd say. Being single-family homes, really driven, being very sensitive to interest rates.
Yeah. This recent drop is only matched by the drop that coincided with the beginning of the pandemic, but where that drop bounced back very quickly, I think this drop is going to take more time to recover.
Yeah, it's only half. It's almost only half the level that it bottomed out in the pandemic. But that was, to your point, very short period of time, and there was a period where everyone was like, "Well, is the world ending? What kind of apocalypse situation are we dealing with?" So that kind of makes sense.
Yeah, I don't see this recovering nearly as quickly. I think that there is some overdetermined factors, a multitude really of factors that are pressing upon the home builders, and it's not just labor issues. Again, it's inflation, and it talks about this in here. I'll just read this paragraph here. Affordability is the greatest challenge facing the housing market. Production bottlenecks, rising home building costs, and high inflation are causing many builders to halt construction because the cost of land, construction, and financing exceeds the appraised value of the home. In another sign of a softening market, 13% of builders in the HMI survey reported reducing home prices in the past month to bolster sales or limit cancellations. Inflation is a term to describe a general, like I said before, is a general increase in the price of all goods. It's like they say, too much money chasing too few goods, but it's not just a few goods. It's a description of a wide scale economic condition. And arguably, supply chain issues and commodity price increases weren't exactly inflation. It was specific commodities. There were specific logistical issues. There were specific things that were limited. Sometimes lumber was high, and now it's lower than it used to be.
Only that stuff grew on trees.
Yeah, exactly. What this report is suggesting is that there is an inflationary force that is coming up on top of the material and labor shortages that we had that were specific, and that's making the builders feel less confident about building more homes. We're not getting out of the housing supply shortage anytime soon, and I think this could be a sign that existing developments could be delayed as well. If time is money and they're really hurting for things, maybe they're cutting back on labor, and maybe that's going to make projects a little bit longer. But I think that could really, really hurt our ability to bring more supply online. I don't know if we'll get to 450 built like was expected, but yeah, we'll see.
Yeah, that could pose some problems. We have to build our way out of this housing crisis.
Yeah.
And if builders stop building, we're not going to exactly make too much progress on that front, and prices are going to stay elevated, and rents are most likely going to stay elevated, as well as there's only so much availability of housing. I've
been listening to there were several podcasts about the housing crisis that came, and all of them touched on really housing supply. I don't even think they mentioned things like vouchers or price relief directly from the government. It was like, let's eliminate some of this regulation, let's bring on more supply. And really, it's the idea of NIMBY regulations that are getting in the way of home density. And I'll make an argument here: renters are people, and they're part of the community too. And they deserve a voice.
It's a very woke opinion of you, Matt.
I know exactly. That's right.
Renters are they're human beings. Yes.
So if you build more apartments, the price, we saw that, we even reported on this in the Gray Report. You build an affordable housing complex, and more often than not, prices of the surrounding properties go up.
Well, they certainly don't go down.
Yeah, and they don't go down. And it's just it's very frustrating to think that there's only one kind of area of people that are tied to a specific place, and just because you rent instead of buy, they should have a voice there too.
Yeah, you're a stakeholder in the community. Yeah. I agree. Yeah, I mean, and who really owns anything? I mean, at the end of the day, you're still paying property tax. There's no true, free and clear, whether it's, most people have a mortgage, and so, the bank can foreclose and take it from you, and the government can take it from you if you don't pay your property taxes. And so, there are some differences between renting and buying, but it's, just because you are a property owner. Historically, there's a lot of, historical context that gives property owners, more rights and more say. But I think that we've really moved beyond that, and just you can live in a community and still be an equal stakeholder. You don't have to, own a piece of you don't have to own a single family home.
Yeah, doesn't matter what you're signing, if it's a mortgage or a lease. At the end of the day, you live somewhere, you're going to be part of that community, whether you like it or not.
Yeah, and 100%. All right. Well, so Matt, do we have time to go over Marcus and Millichap? They've got some stuff on inflation. We talked about inflation. We should probably. We talk about inflation a lot. We have talked about inflation.
I think we could touch on it
specifically.
Before I watched and read these two pieces, I kind of tried to solve the problem myself. I kept thinking about interest rate hikes, but John Chang actually notes that recession risks and reduced capital inflow could be a couple of other ancillary effects of rising inflation for CRE, and those are the three big categories that he divides it into: is interest rates, recession risks, reduced capital inflow. I think that recession risks, to me, are the big one. As we said before, CRE and multifamily in particular can provide somewhat of a sanctuary if you find the right investment. When we're talking about inflation, we have been over this and how multifamily, it's a yearly rent, and so we can kind of float above it, and these rents are happening every kind of regularly.
Yeah, you're signing new leases all the time.
Yeah, so it's not like it's every year you switch and then it's the new year. People sign leases at all times of the year.
Yeah.
But maybe if it's an office property, industrial, or retail property, you got a 5-year, 2-year, 10-year, 20-year, I don't know, a longer lease where you may have made the wrong inflation prediction.
Yeah, maybe there's inflation escalations, maybe there's not.
So when they're talking about people, when that third part, when it's talking about capital coming into CRE markets, maybe that is true for markets as a whole.
I think that's...
We could be coming from... There could be industrial investors coming into multifamily is my
That's true. I mean, the counter argument to that is just industrial has been doing so well.
Okay,
and
maybe not industrial, but office and retail.
I think office, retail, hospitality, but also I think the stock market and people who are overweighted to the tech sector are looking for more value, looking for real assets. I think that there's a lot of groups. I'm talking to a lot of RIAs and wealth managers who their clients are hungry for real estate right now. And multifamily as at the top of their most lists. Industrial, I would think, is number 2, even though industrial's had some of the highest returns of all the CRE asset classes. But I do think that maybe that capital flows may be more important to determine value, current and future valuations.
For sure.
Maybe even, I think, more important than they are more important than interest rates, because I mean, interest rates can be high, but still someone can come in and write a big check, and a lot of groups can. If there's just so much capital flowing in, and they're willing to accept a lower return because they're not looking at cash flow, they're looking at total return, or they're looking at IRR, or they're looking for diversification into real assets compared to the stock market. And to them, maybe a 2 to 3% yield is just fine because they're allocated to the asset class that's uncorrelated. And so if the capital inflows remain the same or if they increase, then interest rates may not move the market and valuations like some are and that we've talked about. But if those capital flows slow down, turn off, that's where you could see things move incredibly fast. Because the interest rate, it's one variable of the return outlook, but you still have somebody willing to pay a price, and what are their motivations? And interest rates mean more to us because we have certain return criteria that we're trying to achieve that we have to hit. And so interest rates, especially since we're yield and income cash flow focused, those interest rates severely impact that. So we're a little more sensitive to than others, maybe a pension fund or an insurance company that isn't really looking necessarily for a lot of yield. They're looking for diversification. They're looking to get invested in the space, and they're looking at the total IRR, and they're like, okay, 12%, we'll take it. Whereas we're like, no, we want the cash flow, and we want 18%.
And what I was thinking too is, this inflow could make, like I said before, it could introduce a little bit more volatility and risk when people are clamoring for investments, and but that's kind of the beauty of real estate in general is you can pick a market, and if you believe in that market and maybe it's stable, maybe it's in the Midwest. And
what's your time horizon? Because I think having a short term, I'm going to get into this market real quick because I've got an opportunity over 2 years, get in, get out. That's a whole different concept than the long-term trends of this market and this asset are very positive. And I'm taking a 10-year outlook because I can be much more certain about an outcome of an investment, not specifically the return is going to be X, but whether it is reasonably profitable over a 5 to 10-year period. I can be incredibly confident and much more certain about that than, hey, we need to hit this number in 2 years. I don't know what's going to happen in a year and a half from now. I can do everything right, but something, asymmetrical comes in or just something that you can't predict. It's hey, got to change plans. Not going to work. So
completely agree.
And so you may have been watching this piece from Marcus Millichap, John Chang. Again, I highly recommend going and checking that out. You can find that on the Gray Report. You can go to Marcus Millichap directly. One great way, Matt, to get all this stuff, just make sure it's sent to your inbox because that's the easiest way to get it. GrayCapitalLLC.com/newsletter. You're going to be able to sign up for the Gray Report newsletter. I mean, how many articles and reports are on the newsletter on average on a given week? So
22.
22, Matt.
Never less than
5
20.
or 6 of these today.
Never less than 20.
Never less than 20. And these are all important reports. I mean, some of it's not all multifamily. Some of it's more economy driven. Sometimes it's another commercial real estate asset class. But all really important information. And again, we did this initially, Gray Report newsletter, for our partners and our investors. What we found really interesting is that, not that we have a lot of investors that follow the newsletter, but it's industry insiders. It's syndicators, it's brokers, it's lenders, it's developers who are telling us that the Gray Report is a critical tool and piece of information, and it's what they look forward to every single week. Yeah. So if it's something if you're serious about really understanding what's going on in the industry, I honestly don't know of a better resource that aggregates all the information in one place.
Yeah.
I mean, there's some other good sources out there. I mean, Globe Street's good.
Here, I will say, we may not report on every single acquisition that happens in every single market, but
who does?
Yeah, I try to. I'll get the reports of everything, and I try to find things that are equally accessible for everyday investor.
Well, it's curated. It's not just a bunch of data.
Yeah.
It's definitely curated content, but a high volume of quality content. Now, we have even more on grayreport.com, which we haven't even mentioned yet. I mean, there's a ton of stuff. It's updated every single day. I mean, it's anything that comes across the wire, it's going on the grayreport.com. So I highly recommend graycapitalllc.com/newsletter. Make sure you've subscribed to the Gray Capital YouTube channel so you can watch these videos as soon as they come out. Give us a like and submit a comment. All that helps push the videos out through that YouTube algorithm to other individuals if you think that it is worth sharing with folks. And just a quick announcement. Should have done this earlier on, Matt, but we got a new fancy website that I know you've spent a little bit of time working on recently.
Yeah, we're launching. We're just launching it today, I think.
That's the plan, right?
And yeah, I'm pretty excited. It looks pretty nice. So I think it's a real standout.
Yeah, can we show? Oh, we probably aren't logged in on this computer.
Yeah. But
you'll have to go.
We'll get
graycapitalllc.com. Check out the new website. Send Matt an email if you find any any errors.
Yeah.
Matt at graycapitalllc.com. No, it's great, Matt. You did a great job. Catch you on next week's Gray Report. Make sure you sign up for the newsletter, so make sure you get the newsletter this Thursday. But until then, have a good one.